trade war heats up. Trump threatens retribution over soybeans. Meanwhile, Stellantis is doubling down on U.S. investment with a $13 billion bet. Let's unpack what's going on and what it means for global trade, farmers, and automakers. Quick context. Tariffs are back in the spotlight. The Trump administration has leaned on higher duties to pressure China and protect domestic industries. Recently, he floated retribution over China's soybean purchases. Basically, if Beijing cuts back or plays hardball, the US hits back with more tariffs or targeted measures. China's signaled it won't be pushed around. Selective counter-tariffs, slowing approvals, pivoting purchases to Brazil, pivoting purchases to Argentina. Globally, that stokes the same fires we saw last cycle. Supply chains reroute shipping costs, get messier, compliance gets messier, and price pressures trickle into anything with steel chips or food oils. Inflation might not spike overnight, but it adds friction everywhere. Now, the Stellantis story. The automaker behind Jeep, Ram, Dodge, Chrysler says it's committing about $13 billion to U.S. manufacturing. Reporting from Reuters, AP, Axios, and the Financial Times. Why? To hedge against tariff shocks, shorten supply chains, and qualify for domestic incentives. It's a way to control more of the build at home so cars don't get tangled in cross-border costs. Where's the money going? Plants in Illinois, Ohio, Michigan, Indiana, with Belvidere, Illinois, a big symbol after prior shutdowns. New or refreshed models, more parts localized, and upgrades that make EV and hybrid production easier. It's not just a press release flex, it's a counterbalance to tariff risk. If importing parts or finished vehicles gets pricier, you bring more of that work inside the fence line. So what does this all mean? For U.S. farmers, especially soybean growers, China is the biggest customer you don't want to lose. If Beijing shifts purchases to South America, U.S. exporters face lower prices, more storage, and a scramble for alternative markets. Government support can soften the blow, but it's not the same as steady demand. For global trade, this raises the chance of escalation. One tariff leads to another, and suddenly suppliers are redesigning their networks. Southeast Asia gains some links, move to Mexico, others onshore in the U.S. The result is redundancy over efficiency. Good for resilience, not always great for prices. For automakers and manufacturers, the playbook is clear. Reshore where it counts, chase incentives, and hedge with multiple suppliers. Expect more joint ventures for batteries, joint ventures for critical components, and more pressure on Tier 1 suppliers and Tier 2 suppliers to localize. For consumers, brace for a slow grind. Cars, appliances, even groceries can creep up in price. Promotions and financing can mask it, but base costs rise. Geopolitically, U.S.-China relations enter a familiar cycle. Tariff threats, targeted retaliation, then quiet negotiations. Allies watch closely. Some align with U.S. measures, others exploit the gaps to win market share. What's next? China could dial up purchases from Brazil, tighten export controls on key materials, or delay approvals for U.S. companies. Other countries may seek exemptions or set their own defensive tariffs. As for Stellantis, the bet could pay off with steadier costs, faster launches, goodwill for creating jobs, or strained margins if demand softens and capex runs hot. Final thought. In this trade war, the strategy is shifting from just slapping tariffs to restructuring how and where products are made. The map of global manufacturing is being redrawn in real time. And this is one of those moments where the lines matter.